Well, the Fed's preferred inflation gauge, PCE, ticked higher in July, up 3.3% from a year ago, with the core print, excluding food and energy, rising 4.2% year over year. Now, this comes after the Fed reiterated its target of 2% inflation in Jackson Hole. Now, investors are still hoping that the slowing rate of growth means the Fed can hold rates steady at the September meeting. Joining us now with his perspective on what we can expect for markets is Sean O'Hara, Pacer ETF President. Good to have you on the show, Sean. So break down the reaction to this PCE data. We know that the Fed won't just look at one thing, and there's a lot of time still to go between these meetings. But what are your big takeaways as to how you think the Fed is looking at this data?
Well, thanks for having me. I think the Fed has been pretty consistent the whole time with regard to what they're looking at. They're looking at their target and they're trying to get there. I don't think what's currently going on in the market is going to back them off of their current path of continuing to tighten and potentially even raise rates some more. The big driver and the thing I think they're most worried about is that, the price of oil, for example, has gone up over 20% in the last 30 days. And oil's in almost everything. It's in transportation, manufacturing, it's in heating our homes and running our businesses. And so if that spike in energy sort of reverses the course of slowing inflation, I think that'll give the Fed everything that they need in order to continue on their path. I think the market has sort of been going up and down, if you will, based on two camps. One that thinks eventually they're going to pivot and bring rates down, and the other who thinks that they're going to continue to stay the course. I'm in the stay the course crowd, which means I think the market, as far as overall valuation, is potentially susceptible to a little contraction because inflation is remaining fairly stubborn.
So being in that stay the course camp, then, what are some of your stock picks at the moment to sort of ride this storm out as you're taking that view?
Yeah, I mean, I think in this environment, everybody's talking about the Magnificent Seven, and they're certainly, had a great run so far, at least up until the last month or so. I think perhaps the last month or so they've pulled back. I think in this environment, I think you want to buy stocks that pay dividends, give you a little bit of money today. I would think you want to lower your overall portfolio's PE before the market potentially does that to you. And so I think as you think about it, the energy names are historically cheap. We are overweight energy in one of our large funds. We like outside the U.S., for example. We've been underweight as investors here in the United States, international and global, and there certainly are cheaper opportunities to invest over there with single-digit PEs and in some cases very, very competitive dividends. So I think, you need to be thinking about, is it time to rebalance? I'm not saying completely get out of, attacking the big seven, but I think reorienting the portfolio a little bit towards other things makes sense. Every once in a while or so, we get in this position where a small number of stocks drive the market. It happens, but it never lasts. And so if you know it's never going to last, then you have to think, well, what does it not lasting look like? And it either looks like those big names come back down to earth, or the rest of the market picks back up and catches up. In either case, remaining cap weighted, in other words, just buying the broad index like the S&P 500 or the NASDAQ 100, doesn't do very well in that environment. If the big names come down, you're going to have an overweight to those names, and so you're going to suffer from that. And if the rest of the market catches up to them, there's not enough weight in those broad indexes to really be meaningful. So thinking about alternative weighting schemes like equal weight or weighting your portfolio by something other than market cap is a way perhaps to think about the rest of this year.